Hey, Steve Saretsky here. As always, Canadian real estate market update with a particular focus on Vancouver. If you get any sort of value and entertainment out of these videos, all I ask that you hit thumbs up and subscribe. Questions, comments, put those below. I wanted to touch this week on a important topic, which is really why this channel was created from day one. I think there's obviously been a lot of you that have been following along over the past several years, and when I started this channel, it was really just all about how do I provide value to people, how do I create an engaging community, particularly as it pertains to finance, and obviously real estate plays a major component in most Canadians' financial situations, and that's obviously a space that I work day in and day out advising professionals, central bank, financial institutions, etc. That it was all about, okay, how can I look at the data, how can I present it and have a dialogue, and let's see. Again, I'm not here to make predictions. I'll be the first to admit that I've been wrong in many occasions, but it's still about, okay, let's look at the data, let's peel it back, and let's hear your thoughts. And so I'm looking at the comments over the past several weeks where obviously people, I think, are letting their emotions get in the way of their rational thinking, which is that it's not necessarily, you can't look at things and say, well, this is what I want to happen. I want housing to go down 30%, or I want housing to go up 20%. You start looking at it in the way that what you want and say, okay, what is actually happening? So when the facts and the data change, I think that should play an important role in changing your view on a certain asset class. So, for example, back in March, when the stock market was crashing, back in April when the real estate market was shut down as we locked down our economies, is anyone here in this channel that was watching these videos back in March or April had the foresight to say that by November we would be hitting all-time highs in the stock market? Did anybody suggest that by November the single-family detached house prices across basically the country would be up by double digits? I would love to hear it. If there was some brilliant person out there that had the foresight to see that and make that call, I would love to hear it. I'd love to see your financial statements of all the great investments that you've made. Because I think this is important to say that clearly, the data has changed. So, for example, we had in the real estate market here, the belief back in April was, okay, this is looking really bad. We have a lot of job losses. We have a lot of financial pain to come. Now, did we expect, again, that fiscal deficits would ramp up to $500 billion, absolutely record? Did I think that the Central Bank of Canada and globally did I think the Bank of Canada would grow their balance sheet by 350% over a 6-month period? I did not foresee that. And again, if anyone that had the foresight to predict that the Bank of Canada would grow their balance sheet by that percentage, that they would own 35% of the Canadian bond market within a 6-month period. Again, I would love to hear your wisdom. In fact, I think you should probably open up a hedge fund. So now we look at this deferral cliff. That was obviously the one thing that everyone's looking at and say, well, okay, the real estate market might be taking off, might be a little bit of pent-up demand, but obviously it's going to slow, and it's going to peter out as this economic reality hits. And this mortgage deferral cliff, particularly which CMHC is rightfully so highlighted, will morph into a massive wave of foreclosures. So again, I agree. I think that was clearly something to be cautious of, and I was certainly one advocating it in my videos in the early stages of this. But now, as we look through the data, as things transpire, we have public financial statements from publicly traded companies that have more recently released their statements. So we have First National, which saw their mortgage deferral cliff that peaked at 14%. So 14% of First National's residential mortgages went into deferral, and now they're saying they're at 0.7%. So basically, a lot of these people have resumed their payments. Now, again, I understand that just because you resume a payment doesn't mean that you're you're no longer in financial stress. It doesn't mean that in 6 months' time you won't default and miss a couple payments and eventually go into foreclosure. I am certainly not going to be the one to deny that, because that's probably for quite a few people that will happen. But did I think that the deferral cliff would go from 14% of mortgages in deferral down to 0.7? No, I think that's extremely low. Same thing now we have Equitable Group, one of Canada's largest alternative lenders. These people did shorter deferral periods. They did not do 6 months like the big banks. They did 2 to 3 months. So Equitable Group, their deferrals hit 6% of their portfolio, and they're now down to 0.3%. So again, that's not to say that these people will not run into financial difficulties in 3, 4, 5, 6 months, maybe 12 months from now. I am not going to argue that. But we have one last one, which is First National, obviously a larger institution here in Canada. We already touched on First National. We have Home Capital Group, where they are saying that 97% of their deferrals are now back and have resumed payments. So 97%. So they've seen a massive drop off in the number of people deferring mortgages. So again, if anyone had these numbers pinned back in April that said you would have had a deferral cliff that peaked out at, say, nationally around 18%, that would have dropped off as significantly as it has, would this have changed your mindset? Had I told you in November that, First National's deferrals will go from 14% to 0.7%. If I had told you that back in April, would you have believed it? So again, this is an important thing to contextualize, because I think when the data changes, this has to clearly have an impact on your investment thesis. So for example, did I suspect, as I talked about in last week's video, that the federal government would run a $500 billion deficit this year and hand out $2,000 CERB checks to anybody with a pulse? No. Did I think that the CERB payouts, did I think that the fiscal spending to replace lost wages would actually overcompensate for the number of lost wages, i.e. the amount of fiscal support actually overcompensated for lost incomes in Canada? And again, did anybody have that in their model? So these are things to weigh in. Did I think that the central bank, the Bank of Canada, did I think they would grow their balance sheet by 350% in 6 months? Did I think that in 6 months, in a 6-month time frame, they would be capable of buying 35% of the government of Canada's bond market? I did not suspect that, and again, I don't think anybody else did. But these are unprecedented times, and these policymakers are literally making things up on the fly, and they are changing and rewriting the rules of the game. And I think that it's important to understand that these rules are being rewritten, and that you need to understand that these goalposts are being moved. And what does this mean now for your financial well-being? What does this mean for your assets if you're sitting in, say, cash, for example? Now, what I want to touch on here is an interview recently, this past week, from Russell Napier on Real Vision TV. And if you don't know who Russell Napier is, he's one of the most respected minds in the financial space, okay? One of the most respected people, and he put out a brilliant interview on Real Vision. In fact, it was so good, I'm in the generous spirit. If you want a 1-year subscription to Real Vision TV, which I think is the best financial information on the internet today, I will give one person an annual subscription at my cost. Comment below why you should get it, and I will give that out. But just so everybody knows, I'm going to clip to Russell Napier's thoughts. This is a guy that has been in the deflation camp. This is a guy that has been very accurate in his findings and his documentation. He's extremely well respected, and I think that he makes a very good point. A point that I made in last week's video. So ironic that he comes out this week with a similar view, and I think that let's clip to Russell Napier's thoughts right now.
I think the stunning statistic for anybody who's thinking about inflation is the end result of all of this on a global basis. And the end result is this. We have a figure, it's called the OECD total money supply growth number. And it begins in first quarter of 1981. It is currently at 17.4%. Since 1981, there has only been 4 readings above 17.4%. So we talked about the inability of banks to lend, the inability to create money. And suddenly, in the deepest recession since World War II, we've got basically almost the fastest growth in money since 1981.
So, as I talked about last week, when you have the money supply growing as it is during an economic deep recession, depression, whatever you want to call it, that should make you reconsider your investment theses. Whether that's in the stock market or in real estate or in Bitcoin, whatever that is, that should give you pause to say, okay, something is changing here, something is happening. What does this mean? As opposed to being stuck in a narrow single mindset of, oh, this asset will have to do this over time. This is what the inevitable outcome is. Understand that the goalposts are moving. And for those of you that are on Real Vision, Russell goes on to suggest something that I tend to believe and agree with, that governments are going to come out with more policies, that they're going to try to keep the shtick up. They're going to try to keep the money supply growing. Central banks are becoming more intertwined with the government. The federal government is going to be backstopping more of this credit in order to get the banks to lend money out. Because it's one thing for a central bank to lower rates down to zero. It's one thing for them to do QE, but they ultimately are not the official money creators. Money gets created through commercial banks. So again, if I need to simplify this, think about it like this. You have the Bank of Canada, so the Bank of Canada will lower interest rates. They still need RBC Bank and TD Bank to go out and issue credit into the economy. That's how you get growth. You need credit growth to drive GDP. So if RBC doesn't want to lend to Bob's Bakery because the business outlook doesn't look very good, there's no loan for Bob. There's no loan for him to start up a business and expand his company. So they need, how do you get RBC to give out credit? So you have to get the government more actively involved in basically backstopping some of this debt. And obviously that's what they did in the housing market. That's why you had banks lending aggressively into the residential real estate market, because basically residential real estate market is implicitly backstopped by the government. It's become so large that it's basically deemed too big to fail. It's the single largest driver of our economy, so we need to keep it pumped up at all costs. And that, again, it's not whether you agree with that dynamic. That's what it is. I'm not saying I agree with that. I'm not sitting here and telling you that I agree that we should implicitly backstop the housing market, that no, over-leveraged speculator should be allowed to fail. I don't agree with that policy, but that's not for me to decide. I'm not a policymaker. I'm just telling you that's the actions that they're taking are proving that. And so one thing that Russell goes on to talk about in his interview is that, for example, what they're now doing, what they're lobbying for in London in the UK, is they're making a push towards they want to push for a 25-year fixed mortgage. So similar to the US, where you can take out a 30-year fixed mortgage today at 3% interest. Could you imagine locking in a debt at 3% over the next 30 years, looking what governments are doing in terms of fiscal spending and central banks basically monetizing this debt? Could you imagine having the ability to lock in that credit and just letting them inflate it away? That's the one thing it's frightening in Canada, is that you take on a massive mortgage and then every 5 years you have a rate renewal risk, and that is a real risk to our real estate market still. And that I think that the Canadian politicians, the government, and policymakers are aware of that risk. And I think that I would not be surprised if they try to move again in that direction, because I've always said before, if we go from rates today at basically 2%, if rates go to 4%, the real estate market blows up. It's done. So you then have to look and say, okay, will policymakers willingly let that happen? Or will they look at alternatives? Well, now, what are their alternatives? To me, the obvious alternative is saying, okay, if rates go to 4%, we allow OSFI comes in and they say, okay, we're now allowing, a 35 or hey, maybe a 40-year amortization, or you start to look at, say, how can we expand our bond market and allow longer duration fixed term mortgages? Because it's inevitable that you will get inflation at some point. That could be a year from now, that could be 5 years from now, but it's inevitable at some point. The genie will come out of the bottle, and at that point, that's when policymakers again will have to get creative. So again, just understand that the goalposts are always moving, and it's I feel, responsibility to stay on top of those goalposts and understand when they're moving and explain how and why they're moving, so that we can have a proper dialogue here. At the end of the day, it's really just about financial education. So hope that helped. Brought you some value entertainment. As always, hit the thumbs up, hit the subscribe button, and we'll see you next week.